Cool. All right, everybody. I love y'all, but y'all crack me up sometimes because this is the reason why I feel like sometimes when I do fundamentals, y'all don't listen because the stuff y'all DM me and ask me like 6 to 8 months later, and I'm looking like, didn't we cover that on the Zoom call? And then I go back to my notes and realize it was something that I wrote down to cover. And just to verify, I actually go and listen to the Zoom call. And y'all, y'all have been asking me out the wazoo about Amazon. Let me tell you something. Amazon, Netflix, Facebook and Netflix, I don't even want to include, but Apple, Microsoft, Nvidia, AMD, um, all of these tech stocks, like when inflation is high, these companies are not going to do well at all. Um, it's a part of the cycle with tech stocks. So whenever you have a retirement account, a 401k, or just your personal investment portfolio that's heavily stock weighted towards tech, you have to realize that in times like this, these companies have to regroup. And then there's also a science behind stock splits. So Amazon just did a stock split not too long ago. You have to recover revenue and earnings to surpass the amount of shares you just dumped onto the market. Otherwise, your earnings per share is not going to be there. Um, Also, like the numbers that came out for Amazon weren't like horrible. It's to be expected. Like, if you were like, okay, in December when the Fed said that they were going to raise interest rates, you should have known this was coming. Like, you should have known, like, after the second or third interest rate hike, this was going to happen. It's a part of the nature of tech stocks because you have to think about where their revenue is driven from and how tech stocks make their money. Um, Tech stocks do a lot of expanding and do a lot of growth out of periods of time when money is cheap. So when interest rates are low, tech stocks tend to boom because first of all, you get a lot of startups, you get entrepreneurs, the big Silicon Valley group that will, say, hey, got this loan, got this grant, we can go get this money really cheaply from the bank. We can start up a business, have a really great idea, and then someone like Facebook will come along and say, oh, you know what? That's something we can really integrate into our business and pay $1 billion for it or pay whatever for it and buy up a startup. Because um, when you think about tech stocks versus stocks or companies that have physical product, it becomes cheap for everybody to do business, but it's cheaper for tech stocks to grow and expand during times of low interest rates because their overhead is super, super low compared to a retail store that has products and they got to print and they got to do all this kind of stuff. When you look at Amazon's numbers, their ad revenue or their ad dollars up. Um, when you look at other elements of the business, like their actual revenue itself, up. Like, Amazon's not bad. Amazon just happens to fall into that category of being tech because they don't have a true physical product. Most of their business is done online, so their overhead is cut. And then also, it's a lot of forward projecting that gets put into those numbers as well. So, um, Amazon's not bad. Apple is not bad. Um, Actually, if you look at the month of October, it wasn't super bad. So October tends to be one of the worst performing months of the year. And I went back and I actually looked at this October. um a lot of money on the back end from stimulus is still pouring into the market. It'll finally like kind of come to an end at the beginning of December. But that money is still kind of there. You have people who still have money in the bank and money to spend. So the money didn't dry up as fast as they thought that it would. So the anticipation for a hard October wasn't really there. So businesses were actually able to still make money. If you look at ad dollars put into the market for a lot of businesses, companies that had never really spent money on ad revenue started doing so. Government entities that had never spent money on ad dollars started to. Case in point, the Secret Service. The Secret Service does not pour money into ads. However, if you go and look at the ad dollars that the Secret Service used to put ads out on um, YouTube, Hulu, if you have the ad version of Netflix, streaming platforms, let me just put it like that. Streaming platforms. If you have a streaming platform and you are on it in the last 3 to 4 months or so, it's highly likely that you would have seen a Secret Service ad, unless you get to the point where it says skip ad and you still have a couple of ads left and you just skip. Um, you may have missed it. But anyway, um, so it's stuff like that that's going on um right now. And then also we're in an election year, and we well, for October, it was a month before the election. So a lot of things like that come into play. Macro Trends is a pretty cool website for you to go and look at the October trends. You can look at trends in an election year, years where there's not an election. Octobers tend to be worse in years where there aren't elections, but October's just they tend to be bad overall. But this one wasn't. Um, so that makes me wonder what November is going to be like after the election, and then also December. Today we got Fed news, um interest rates. So this should not have been a surprise that interest rates were going to go up. Um and we got press conference from Jerome Powell, and so now the current Fed's fund rate sits at 4%. Um the news that everyone now is going to be looking forward to hearing is Friday. So Friday we have NFP. Those numbers are going to help to show us what the labor market is looking like. So here's the conflict, and here's why and how you can start to see that the Fed is not a government entity. So how can I put it? All right, so the Federal Reserve, has a goal of how they want inflation to be tamed. I'm just going to put up, I'm going to share my screen and put up the Forex Factory calendar just so that you guys can see it, but I'm not really talking from it right now. All right, so the Fed has this goal of cooling inflation, controlling pricing. But in order to do that, there are other things they have within their control that they can use to help try to tame that. Overnight market spending, the quote unquote indirect or back end stimulus that they do. So they have that they can tame. Um, Being able to raise interest rates to help slow down the demand in the market. Because if you drive up interest rates, then you know that it's less likely that people are going to take out loans and borrow money, and it's less likely that banks are going to lend money. This slows down growth for not only the banks and corporations, but individuals as well. And then as companies start to slow down, tame their businesses, they tend to cut back on hiring, bonuses, pay increases. Sometimes they lay off, furlough people, or they just let people go um, without cause, fire people that they just kind of been letting, just kind of hang on until the next thing happens. So the Fed has all these things within their control. They know the chain of events that happens when you raise interest rates and such. Stimulus is the complete opposite of what the Fed is trying to do right now. They're trying to dry up money from the market. However, our current government administration is doing stimulative things to the market. So they're fighting each other, not like literally fighting each other, but the things that they're doing are literally the opposites. So they're in a way kind of sort of quote unquote kind of sort of canceling out what kind of stimulus things or what kind of measures is this current administration doing that's canceling out the Fed is. So there's still checks going out for COVID. There's still relief checks going out. They're um, increasing retirement in some areas. They just put into place a change in the retirement limits for retirement accounts, 401ks and such. So the limits are up on that. And then also you have student loan forgiveness, which is another form of stimulus. Even though people aren't going to be getting that money directly, the money is still going to be money that people won't have to pay on a monthly basis. So that increases the monthly income or the monthly allowance that a person has to spend. Those are all stimulative measures. So whenever we talk about the Fed increasing interest rates and how high will they have to increase interest rates, there's going to be a pain point. There's going to be a point where it's going to hurt. It's not only going to hurt the consumer, it's going to hurt business, it's going to hurt banks. Everyone's going to be feeling the pinch. So right now, a lot of consumers say, I'm feeling the pinch. I don't like where prices are. You don't hear it quite as much anymore because of a few things. So the EIA website, the website that you can go to look at energy numbers from the government, you can actually see the release of oil and oil byproducts across states. You can also see where administration asked several states to just take away the tax, like that local tax that goes into gasoline. So when you go to the pump, you're looking like, oh man, I remember when gas prices were almost $4 a gallon, and now they're like hovering under four. They're hovering under four because a lot of states have been incentivized to take away tax. So you're literally almost paying like the rock bottom price for gasoline, almost. Um, Not only that, but if you look at these energy numbers, you will also see how um, you will also see how sorry, I just lost my train of thought. Um, okay, sorry. So you'll also see how in these energy numbers, the byproducts have been released into the market. So our strategic reserves are supposed to be kept at a certain They're called strategic reserves for a reason. So if at bare minimum, so if everything shuts down, the strategic reserve is supposed to be there to help emergency vehicles, and emergency supply transports. It's not for consumers. It's not for average everyday person to just be able to go to the gas station. They literally lock down the gas stations and say, look, like no one gets gas except for these people that fit this criteria, and that's it. We currently in our strategic supply have been offloading natural gas. We've been offloading gasoline. We've been offloading kerosene, um, and jet fuel. So those strategic supplies have been diminished. So it's a couple of reasons why we've talked about one, and this one is kind of the domino for the rest of them. So we have been giving petroleum products. I'll just put it like that. We've been giving petroleum products to Europe because their embargo on Russian oil goes into effect in like a month, where the caps are in place and the import embargoes are in place. This means that it has to be supplemented somewhere, somehow. So, you can take this however you want to. Our current administration feels like it's better to keep an ally than it is to help Americans stay warm this winter. Why do I say that? You remember a couple of weeks ago when I told you that in the Northeast, their supply was low, like really low, to the point where actually recently they had declared a state of emergency because a lot of the state and local officials had to come together and petition the White House and tell them, look, our supply is so low that we're having to ask and beg other regions of the United States to help us with oil supplies because our citizens are going to freeze. But yet they think that it's so cool to send oil products to Europe because, oh my gosh, Europe is going to suffer. But when Europe put themselves in this situation, now all of a sudden we have to be their savior. And I get it. I get the whole ethics and morals behind it. But at the same time, you're neglecting your own citizens in a region of the United States where feet of snow and negative degrees is like commonplace. And we're in November right now. Okay. This really tells me a lot about how you feel. You feel more towards the allies than you do your own citizens. So, what happens whenever you're sending natural gas, which is what a lot of people use to heat their homes, and heating oils and such. So, all that, when you look at the EIA website, it all is like lumped together. So, when you're sending this product to Europe, companies have to supplement with something else. So the factories and the big plants up north that usually use natural gas can flip back and forth. They can use diesel if they have to. Well, now if you look at the supply in the United States, we have about 24 days of supply. It depends on how much we actually use. Like right now, we're hovering between like 23 and 24 days. If everything in the world completely stopped here and we only had to use what we had stored up, it would last for 23 days. What they have been doing is supplementing natural gas that has been sent out with diesel. And who and what uses diesel? Trucks, also transport for food, and supplies that we need, and is a major shipping method in the United States, and school buses, to name just two vehicles. They use diesel. also consumers have vehicles that use diesel. So the need for diesel is very strong in the United States. And then also our kerosene supply. You would think that we would have kerosene because it's not one of those byproducts that you hear a lot about. But a lot of people do use kerosene to heat their homes. And we have a shortage of it. Actually, we have a shortage of kerosene to the point where it's almost $6 a gallon for kerosene. So, anyway, um, everybody's been focusing on gasoline because most people know gasoline is what they use every day because they have to put it in their car. But the other gas, or the other oil byproducts, people are not thinking about those. And those are the ones that are really expensive and are short in demand. And it's like smoke and mirrors. I tell you guys all the time about smoke and mirrors. Like when they're pointing you in one direction, look at everything else. Gasoline is not 100% of a barrel of oil. So what do I expect in the coming months? Obviously, high energy prices, energy shortages. This sounds super morbid, but it just is what it is. It wouldn't surprise me if we actually had more deaths this winter because of hypothermia and just people having a lack of food, a lack of water because of how this current energy situation is happening. Um, Also, with companies, with currencies, and such into 2023. Um, so tech is just going to be bouncing around here, there, everywhere. Because until okay, so what has to really happen for tech to bounce back? Because a lot of people ask me about tech. So in order for tech to really bounce back, first of all, the interest rate increases have to level off. And then there has to be some sentiment put out into the marketplace that inflation has leveled off. When you do that, then that will incentivize banks to want to lend to companies. This will incentivize companies to, in the short term, want to grow, but they're going to do like a short term, like kind of burst of growth or innovation, and then kind of like level off because it'll be going into the summertime. Most of tech innovation tends to come out in the fall, so you'll kind of see that happen. And a lot of these companies aren't bad. I mean, I'm just going to reiterate that again. These companies are not bad companies. They have just been subjected to this current market cycle. The consumer might not spend this winter. It depends on how much money gets dried up out of the market. I want to see I want to see the October retail numbers that come out in November to just really get a good gauge for where people are in the market. But I don't feel like people are spending quite as much as they want to. And then even when they are, it's because corporations have decided to kind of take a hit to the pocket to get inventory pushed out so they can turn over inventory. So that's been another push. That was some of what happened during the summer, some of what happened during the third quarter. So we should see some of that kind of show up when we look at numbers. And hopefully, fingers crossed, our next interest rate increase from is the last one until March. If they decide to do another interest rate increase between December and March, and not just wait until the March meeting, then that means we have like a bigger problem than what they're wanting to say. But hopefully they don't have a problem saying it because the election season would have been over by then. Um, and we won't start hearing we won't start getting a more tame Fed, and a Fed that is more careful with their actions until like the end of next year, because then they'll be getting ready to go into a presidential cycle. So for the first half or so of next year, the Fed is just going to do what they really want to do without repercussion. It won't be until the end of the year that they'll kind of slow down and kind of be really nice and gentle about things, because it's all about cycles. Where's the book? um Hold on. Oh yeah. The Science of Prediction, the Market Cycles book that I was telling you guys about before. It's in there. So like it's literally charts and graphs and like explanations of like cycles, presidential cycles, seasonal cycles, tech cycles, consumer cycles, interest rate cycles, real estate cycles. Everything has a cycle, and some of these cycles, when they line up, great things happen and bad things happen. Which is why next year to 2025 is going to be kind of rocky. Um, if you look at cycles alone. All right. I think I'm done. um, I'll see some of the comments, and I'll address them at the end. I'm gonna let Mr. Levels go ahead and do what he does, and then we'll come back to it afterwards.
Cool beans, cool beans. Appreciate that. Glad you're feeling better too, Carmen. Glad you was able to join us tonight and drop the sauce like you always do. All right. Jumping into midweek technicals. Um, in the beginning of the week, I asked you guys about the daily bias. We had a few people say that Monday's bias was bearish. We had Tracy say that her bias was bullish for Monday, continuing the bullish trend that the dollar's being in. I told you guys that I was bullish short term and bearish for the daily as well. So looking at Monday's daily candle, we see that that was a bullish day. Um, and yesterday we got some pullback with the news that came out yesterday, and then today we continued that. Um, we closed bullish yesterday as well, and today we continued that bullish price action. So with that being said, we know with our dollar being bullish that our currencies are inversely correlated to the dollar. So we know that um our currency pairs have been giving us bearish price action this week for the most part. We did get WITs yesterday and today with FOMC news come out today in news, high impact news yesterday. So we see the manipulation in the market, as we call it, with these WITs. But then we see price action do eventually settle back down and close bearish um for yesterday and today. GBP USD, same thing. Um, we had a bullish day yesterday with that pullback for the pound, back up the retest market structure, but then we see we sold off today and closed bearish for today as well. Um, and NZD USD, same thing. Really didn't get any much, didn't get much volume out of NZD USD Monday, and then yesterday was a bullish day, and today we closed bearish. Down now, um, I like charting NZD for confluence and well the inverse confluence with the dollar, but I don't really trade NZD or really any currencies. Um, and I tell you guys a lot about NZD, how she like to do her own thing. She is the one that she diverges from the other two currency pairs quite often. So I don't like NZD USD. Um, metals. Monday was a bearish day, and we had that bullish day yesterday, coming back up to fill in that fair value gap as coined by Michael Huddleston. And then we see today with news, price action pushed back down and closed bearish. If the dollar continues to push bullish for the rest of the week, I do expect silver to come back down and retest this previous market structure right here at this, where we see this daily order block. So same thing would go. We had our bearish close, our bearish day Monday, bullish pullback yesterday, feeling that imbalance here. Um, and today we closed bearish. If the dollar continues to push bullish, I do expect us to push down to about 1550. See, we got a yeah, we got imbalance in there, and then we got this order daily order block right there. So that's a good target. And looking at oil, hmm, see if we respect the current market level that we're at, market structure that we're at. And I would like to see us get above our market structure here, back above $95, so we can start pumping back up to retest 129. We still shooting to retest 129, but I told you guys I just want to get above this market structure before we start longing oil. Um, looking at U30, um, we see that we've had our daily bias for U30 has been bearish. We know U30 inversely correlates with the dollar as well, from my experience. Um, but sometimes it will correlate with the dollar if it's setting up for like a reversal or something like that. So we see um with FOMC today that we had um bearish, very bearish price action with that FOMC news and the fund rate that came out today. Um, hold on, let me plug up my laptop. Um, so yeah, with U30, um, we see the cycle that happened from yesterday to today. We see with the news that came out yesterday, We seen sell side liquidity taken out from here with this down move. And then we see price start to accumulate over Asian markets last night and going into London today. And then we seen right at the open of New York, this low wasn't taken out, that sell side liquidity wasn't taken out. Instead, price action pushed up to retest previous structure and then push back down to retest that New York opening range market structure right here. And that daily um that daily low that the New York AM range usually creates. Remember, that's when we usually see our daily high or low created. But with news today, that that kind of doesn't apply today because of news. However, when we did see price come back down around lunchtime to go into our New York um, PM range from 1 to 4 p.m., we see that our um, New York AM market structure was respected, and that's that setup right there that Keisha was studying last week. She shared a video with us of something she pointed out to us. And yeah, we see that price came back down like she said in her video, and it didn't break back below um New York AM session in this previous low, and then it ran away. Where did it run away back to? Buy side liquidity from yesterday's high that took all um of these buys with it to take these stop losses out here. Sell side liquidity run on stops. And then we see with the news today, we see market just push back up to go ahead and take out these stops up here, snatch that liquidity up, and then we ran all sell side stops right here, taking out all of those stops and came back down to fill in this fair value gap that we have right here. So that was classic ICT index um trading model. Um and so I hope you guys are starting to see it more and more. I hope you are studying those 6 videos over and over and over again till you know them like the back of your hand. But today was textbook for you 30. Um looking at crypto. Let's see if Bitcoin hold above 19 5 right here, this market structure. And if we do, then I want to see us push back up to around 28,000. Um, let's see. Oh, I was on a daily time frame. Frame rephrase that. Yeah, I want to see us push up, not to 28 though. We gotta come back and retest 21,000 first. Get back up in here So right now, really not trading Bitcoin like that. Really just dollar cost averaging in the Bitcoin because she's not really giving us any kind of real volume, movement, volatility, and price action. So yeah, just kind of dollar cost averaging into old Biddy. Um, but they know they be getting over. Why my sell limit didn't execute? They need to stop that, man. Um, but yeah, I want to see U30 come on back down to retest this order block right here. See if we bounce off of that. But if we break through there, then we come on back down to retest about 13, yeah, 1350. And if we respect this market structure here, we ought to shoot back up to at least 1700. They done got me. It's all good. Get you out there. Promise. All right. And with Acorn, you guys already know we dollar cost averaging in off our lows and downside market structure. So if we break through this market structure, we'll be buying more eight right here around $3.75. All right. So with that being said, I'll start recording it this time. I'll take any